The big one from Wall Street later today, of course, is going to be the Federal Reserve's interest rate decision that is due tonight. Robert Sockin, global economist at Citi, now joins us to discuss what is likely. Robert, great to have you with us here. Thank you very much for your time. Now, it's well known that the Fed won't cut rates at this particular meeting. So in terms of watching out for, what are the key things? There will be a press conference addressed by Chair Powell as well.
So I think with this meeting, there is not a lot of uncertainty about the outcome. As you noted, the Fed is not going to cut rates. And the question really is about how dovish or hawkish do they lean into recent data. So I'm going to be watching a couple of things. One in particular, what happens with the Fed's dot plot. That's the guidance for, or the collective view of where rates are likely to head in coming quarters. I think that's likely to change to show 2 cuts this year rather than 3, which was in the previous forecast. It'd be very unlikely for it to stay 3. So the question is, if it moves to 2, which is very likely, what is the distribution of those views? And then the second thing I'll really be watching for is, how does Chair Powell express his views on the recent data in the press conference? Does he emphasize more the strength that we saw in payrolls recently? Does he emphasize the rise up in the unemployment rate, which has been more of a weakening signal? Or does he also emphasize on the inflation front, the improvement we've seen, or the stickiness on the services side? So there's a lot of ways that Chair Powell can take this, either hawkish or dovish.
Oh, which was my next question actually, Robert. How have you read the jobs data that you were just alluding to? Not just in terms of the number of jobs, even hourly wages rose at double the pace than what the market was expecting. Your thoughts on that?
My view, as someone who's spent a lot of time forecasting the labor market and following the universe of labor market data, is payrolls tends to be the best signal, or one of the best signals, of the health of the labor market. So I'm paying much more attention to the payrolls report than I am the household survey report, which tends to be much more volatile and tends to have more issues with measurement, and I think isn't properly capturing the large immigration flows that we're seeing in the US. So I'm less concerned about the tick up in the unemployment rate and the softness in the employment report on the household side. I'm more taken by the strength in payrolls, and I think it shows that the underlying economy remains resilient. Now, the other part of that, as you mentioned, is that wage growth was a bit stronger than expected. Some of that was probably due to some calendar effects within the report, where the reference period fell during that month tends to be a strong month for wage growth. But that being said, we're still seeing tight labor markets, high wage growth, and that's getting fed into still high services inflation. So I think the Fed is going to read it very similar to how I've been, that the labor market and the economy remain resilient, but they're still concerned that there's too much underlying pressure in wages and services prices to be comfortable that inflation is moving back to target. So I think that's very consistent with a Fed that's not going to be in a rush to cut rates and is going to be patient.
Robert, when do you see the first rate cut then? And how many in total? How many rate cuts?
Our U.S. team, they're viewing the data as showing more softness. They think the economy is going to slow down more markedly as we go into the rest of this year. And that's going to lead the Fed to start cutting in December and then in September, and then continuing to cut throughout the year and into next year. So they're looking for the first cut in September, and then a continued path down from there. If, however, the economy is more resilient, which I think is potentially the message from the recent payrolls report, then you're going to see much slower and fewer cuts out of the Fed later this year and into next year. So it really comes down to, how well does the labor market and the U.S. economy hold up? Our U.S. team thinks the first one's in September, and you get a market weakening throughout the year. But it's very reasonable to think that the economy is holding up better than that, and that's going to lead to a much more cautious and Fed that is not in a rush to cut rates.
Robert, what's the range that you're seeing for the 10-year U.S. Treasury yields this year, and what's your view on the U.S. dollar as well?
The 10-year we think is likely going to fall from here. Probably something into the high 3 range, maybe something around 3.9, just slightly below 4, or somewhere even near 4. That's kind of the range I think that we're looking at. But if the Fed stays higher for longer and you don't get those rapid rate cuts that our U.S. team is expecting, I think the 10-year can stay well above 4 for an extended period. So it's really going to depend on how much and how quickly the Fed cuts rates. Now, for the dollar, that's been very challenged as well, because in a higher for longer environment, the dollar is likely to stay stronger for longer as well. So overall, we have been looking, we do think the dollar is likely to cool against many currency pairs as the Fed starts to ease rates. But again, in this higher for longer world, I think you could see more dollar strength than you would expect if rates start to come down. So really, both of those questions hinge very crucially on what does the Fed do in coming months, and beyond that, how long do they stay at an elevated policy rate?
Robert, let's talk about local politics for a quick bit, right? So we've got NDA 3, same government is back. There is continuity in terms of ministers, etc. as well. Your take on what it means for the macros, because it's something very closely watched and much appreciated the way it's been managed over the last couple of years.
I had done some interviews around the India election, and I still think those hold up pretty well in terms of the view that you're probably going to get a government that is continuing with a lot of the pro-growth policies, as you noted, that we've seen put forward in prior versions of this administration. And you'll probably see some adjustments at the margins, maybe some other social policies that you haven't seen in prior years, but also that will be coupled with a continued focus on other policies that support manufacturing, high-tech sectors. And so India has been one of the best performing economies in our forecast. We've recently marked up India growth. It continues to perform very well. So I think this is a very good situation for India, because I think you're going to get a continuation of a lot of those positive policies that you saw previously, but also some new positive policies that are going to support the economy more broadly. So overall, I think the Indian economy has been in a very strong place, especially relative to other emerging markets. And I think that is likely to continue and even broaden out as we go forward.
Robert Sockin, pleasure as always. Thanks a lot for joining in and taking time out and sharing your views on the global macros and the road ahead as well. That was Robert Sockin there, sharing his views ahead of the big Fed decision later tonight. Time for a short break here on Trading Hour.